And now it's time to bring in today's guest. Of course, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff, as usual, great to have you here to talk about the markets.
It is awesome to be with you guys today, Dave.
And of course, now I'm happy to be able to introduce one of our frequent guests, today's special guest, Jon Najarian. He's an options trader, and he's co-founder of Market Rebellion. He's also the co-author of the book, Follow the Smart Money. Jon, once again, our pleasure for having you here with us.
Oh, thank you, David. Jeffrey, always fun to do your program.
Jon, here we go again. I feel like we keep having the exact same conversation. The market's even become more bipolar. You know, a good portfolio manager only has to be right 60% of the time. But I want to talk about something that's near and dear to your heart. You help investors all across America every day through marketrebellion.com and on CNBC. So tell us what investors should do today going forward in this tightening environment with rising rates and rising inflation, because the dynamic has completely changed.
Yeah, I think you're correct, of course, that dynamic has changed. I would basically zoom out, look at the bigger picture rather than zooming in, because on a day-to-day basis, if you trade like I do, then you have to zoom in. And I wish I could be more like many of your viewers, most of your viewers probably, and take that, again, zoom out picture, because the market is still in that same uptrend, Jeff. It's just we're seeing a lot of back and forth. Is the Fed going to overreach? Are they going to throw a 50 basis point rate increase? Right now, the 10-year bond's saying no, they're not. So I think the 2-year bond, because we always look at the 2-year versus 10-year, and again, that's because we're zoomed in. If you zoom out, what you've really seen is interest rates are really low. Corporate earnings in most cases have been spectacular, and they should more or less not pay attention to the noise of the day-to-day trade every day, Jeff.
Jon, the Fed is behind the curve. They didn't get ahead of inflation, and now we have excessive inflation, and they're going to try and catch up too quickly. So that's going to affect investor portfolios significantly if they over-tighten. You said in our last segment, though, only 2 to 3 rate movements, maybe. A lot of financial prognosticators on Wall Street are saying 5 to 7. Why the disparity?
I can't explain other than people grabbing headlines, Jeff, because no right-thinking person really believes that the Fed would basically, you would not only turn over the House and the Senate, but you would have sentiment so negative against this administration if you saw 7 rate increases. I mean, again, I don't think the Fed wants to be political. And if they did such a thing, they would basically throw the baby out with the bathwater. We would see the market down 20% plus. We would see a whole bunch. I mean, what happens when you do that? You have firms hunker down. That means they don't hire. It probably means they lay off. It probably means they cut their spending and all the rest. All of those things are negative for consumers, of course, and the three of us care a lot about consumers. And what we don't want to see is the Fed overreach like that. So somebody saying that, I can't believe they really believe that in their heart of hearts. You're right. The Fed did wait too long, and they did use that transitory term way too much. But now the damage is done. Inflation's been here for quite a while, and it's just a question of, do they want to make it worse?
Jon, Jeff, once again, it's been my pleasure. Great having both of you back here.
Thank you.
Thanks, Dave.